We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Ellie. Glad you're with us today. We talk retirement. It's right there in the name, Decker Retirement Planning. And you can go to that website, deckerretirementplanning.com, to learn more about Brian and the team, find out where the offices are. A lot of great things happening at Decker Retirement, but really great things are happening because they've got great clients, and they're here to help you figure out where you're on that road to retirement. Can I retire? Do I have enough? Will my money last? Are we going to be okay if we retire? Will my loved ones be okay if something happens to me? And that's what Brian and the team at Decker Retirement are all about, helping you figure that out and walking you through that safer retirement process. 833-707-3030 if you'd like to have a conversation with them. You got some questions, got some concerns. I think we're good to go, Brian, but I'm not sure. Great opportunity for you to find out. 833-707-3030. And then we kick off the show every week. I always tell you that you do have the opportunity to do your own research if you would like. DeckerRetirementPlanning.com, under the heading of Safer Retirement Education, there are 12 different things you can download, including Brian's book on retirement, The Decker Approach. You can download any or all 12 items that are on that website, Safer Retirement Education. Hey, Brian, you ready to go?
I'm ready to go.
Man, we got a lot to get to. We're going to reflect. We're going to get Brian J's thoughts on 2024. Get his predictions for 2025. And then we're going to talk about some of the strategies you probably should be focusing on in the upcoming year, and then some key takeaways for the year of 2025. So I guess let's start with the reflection of 2024. I don't think your son graduated Oxford, so you had to go to London for a while. I don't believe you had any parts replaced this year, did you? Knees or any of that? Was that this year?
No. This is the first time in a couple of years that didn't need a new body part. Maybe I need a lobotomy. But let's talk about the Fed interest rate policy and the impacts on the markets. Because right now the Fed is coming this week. As a matter of fact, Wednesday of this week, we'll hear if they're going to lower rates again to a target rate of 4.25% on the Fed rate and cut another quarter basis point. Now, this would be the third interest rate cut. There's two different markets to watch. One is what happens with the Fed. They manage that interest rate, the open market rate. The banks are affected by it. Very, very sensitive are the small caps. Small caps are very sensitive to interest rates. And if interest rates do go down from here, the small caps will have a bigger bump than the larger caps. But it's very, very important to see that if the market is really going to go forward with another rate cut. What we had happen is a quarter rate cut and then a 50 basis point rate cut. We'll see if we get another quarter base 25.25% rate cut. The reason why we say if is because right now the unemployment rate is very low. The consumer price index and the producer price index reflecting inflation are not going down like the Fed wants. They're in fact trending back up. And so it's not a sure thing that they're going to cut the rates. The markets expect them to, but if they don't, the markets will make a correction. If the Fed goes on to a neutral stance, the expectation of the markets is for another rate cut of 25 basis points and then maybe go to neutral. Next year, the expectation was two more rate cuts, and now all of that is up in the air based on what Jerome Powell says at the interview after the rate cut announcement. So again, there's two different bond markets, one that's set by the Fed, but the other is the open bond market rate. You can pull it up by the AGG. That's the ticker symbol. It's interesting that the open market rate, interest rates on the 10-year treasury they've gone up since the Fed has started cutting rates in mid-September. So that is interesting. And a lot of people are saying it's because the economy is not cooling down and inflation is not going down. And we have 36 trillion in treasuries that we have to move. So these bond auctions that are happening are failing because there's not enough buyers at a lower rate. You have to raise the rate to move that kind of a load of bonds. So those are some of the observations for what the Fed is facing. The expectation again is for another rate cut and then probably go on hold. But the markets are expecting another rate cut and then 2 more next year.
How long does that take if the Fed cuts rates again? And I think it'd be the 3rd time this year, right? That's what you said. They're planning on doing it 5, 6, 7 times this year. So they got a really late start before they ever started doing those cuts. But how long does that take for it to get back to the banks, where the bank on your CD is lowering the interest rate, or the insurance companies with your annuities and the interest rates that we saw a bonus for the safe tools? How long does it take to actually trickle back down into the banks and the insurance companies?
Here's an analogy. When gas prices at the gas pump are raised, those are immediately shown at the gas pump. When gas prices are lowered and they're trending down, those are slow and it's
not
based
immediate.
Yeah, that's based on competition. And the similar thing that you see with the banks. So when the banks have the Fed raising rates, those are priced in very quickly. But when the Fed is lowering rates, again, it's interesting, the loan rates have stayed stubbornly high. The mortgage rates, for example, dropped a little bit. They plateaued, and now they're trending back up. The 30-year mortgage rate nationally went down just under 6, but right now today it's around 6.5%. So it's actually gone up. The 10-year treasury yields have gone up. The mortgage rates have gone up. The CPI has gone up. And the PPI has gone up. Those are the inflation indicators, while the Fed has cut rates 2 times, and the expectation is for another rate cut. Now, the biggest beneficiaries of lower rates are small caps and banks. Communication services is another one that's very good, but very neutral. Energy, materials, utilities. In fact, if rates go down, some of the dividend-paying stocks usually go up in price. And bond funds, by the way, bond funds, be very careful because the trend on interest rates is now higher in the open market, not lower. So, for example, the 10-year treasury in 1940 hit 2%. From 1940 to 1980, there was 40 years of interest rates trending higher, from 2% to almost 15% on the 10-year treasury. If you own bond funds during that 40-year period, you would have taken major hits to principal as interest rates have gone higher. Then from 1980, with the 10-year treasury almost at 15%, the interest rates bottomed in August of 2020. We hit 0.47%. Anyone recommending you put safe money in bond funds when interest rates are almost zero, that is financial malpractice. We at Decker Retirement Planning warned and have warned people for years that you have interest rate risk. Interest rate risk is when interest rates go higher, you lose money on bond funds. Please, listeners, radio listeners, if you have bond funds in a rising interest rate environment, you will lose money. In fact, the last 4 years, since August of 2020, the 10-year treasury has gone from 0.47 to now around 4.25, and people have lost over 30% in their bond funds. So we want to warn people to stay away from those.
In that vein, though, because you said that certainly that was during the period of interest rate hikes, during that time when you're losing money. I mean, the theory is when interest rates come down, bonds become more valuable. So if they're coming down, wouldn't that be something to keep an eye on, or no?
Yeah, when bond rates are coming down, but that's not what was happening, Mark.
But I mean, the interest rates, they kind of go the opposite of interest rates. Interest rates go up, bond values go down. Interest rates go down, bonds go up.
Correct. But in the open market, bond yields are going up, bond prices are going down. Ever since mid-September, Treasury yields, bond yields, municipal bond yields, mortgage yields, those are going higher. This is very unusual. Those are going the opposite of what the Fed is doing. That's why a lot of people in the stock market are calling into question. It's not a slam dunk that Jerome Powell lowers the rate again. So if they do, watch for the sell the news reaction to the stock market. Now, some people, and when it comes to research, we think it's a total waste of money to buy research from people that are always bullish. And we think it's justifiably also a total waste of money to buy research from people that are always bearish on the stock market. We try to buy research. We have a 6-figure research budget, and we buy research from people that are pretty neutral and will be able to pick things on both sides.
So you're saying firms that are like our national media that have no bias.
Correct. Okay, but we'll see what happens. There's one outlier. One guy is calling for 1,000-point drop in the S&P in the first quarter because he says that the Fed probably will not cut rates. We'll see in 48 hours if he's right or not. But his point is that the market is priced for perfection. So there's another metric in the stock market called valuation, market valuation. So there's been 4 times that the S&P 500 has ever traded above a market valuation of 30 times trailing earnings, only 4 times. One was 1929, and markets were flat for 17 years. They traded up, down, up, down, up, down, but didn't go anywhere for 17 years to work off that high market valuation. Second time was 1964. Markets traded flat for 18 years. The third time was November of 99. Markets traded flat for 14 years. The fourth time was November of 2021. We hit 32 times trailing earnings. That means that if history repeats, and it's been 100%, we are expecting the next 10 to 15 years to be flat, up, down, choppy, but any passive buy and hold investment strategy will yield a 0 return. Buying and holding mutual funds, stocks, ETFs, those will yield a 0 return over the next 10 to 15 years if history repeats. So it's interesting that the Fed is doing these interest rate cuts now. Now, by the way, another beneficiary of lower rates is gold and silver. Precious metals and commodities go up in value if lower rates produce a lower dollar, the US dollar, the currency of the United States. If the US dollar will go down because all things being equal, that's a favorite economic term, all things being equal, if a country lowers their interest rate, their currency will drop because it's less valuable in the open market. If a country raises their interest rates, they will attract more volume to that country, and so their currency will go up in value. So if the Fed continues to cut rates, the US dollar should drop and gold and silver will go up in value. All commodities will go up in value. But that's another interesting point. That's not happened since mid-September. The US dollar has been going higher. So this is very, very different from most Fed interest rates cuts. This is the third time, and it hasn't worked in the open markets like it's supposed to.
So again, if you'd like to sit down with Brian and the team at Decker Retirement and talk about any or all of this, all right, interest rates are doing this, the bond market's doing that, the stock market's doing this. What should we be doing? That's a great question. But it's really about you and your situation. And that's how Brian and the team at Decker Retirement look at it. If you'd like to have a conversation, there's no cost for this. It's kind of a no-brainer in my mind to get some clarity into your retirement picture. 833-707-3030 again is the number. Totally complimentary, no cost to you. 833-707-3030. We're going to come back. We're going to start the next segment with Brian's key takeaways from 2024, and then we're going to look ahead to 2025. Stay with us. This is Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Back in 1 minute.
The holidays often remind us how expensive life can be. If you're feeling a bit more financially squeezed this season and worry about how you'll fare in retirement, give Brian a call at 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, you can learn more on the website, DeckerRetirementPlanning.com. And of course, you can always give the team a call. There's no cost. You got questions, you got concerns about where you are on that road to retirement. Maybe you're already retired, you got some questions. Maybe you're 10 years out and you got some questions. Call the team. There's no cost. 833-707-3030 is the number again. Totally complimentary. 833-707-3030. We're kind of looking back on the year 2024, and you're going to get into kind of on the stock market trends. What excelled? What struggled? What do you got for us there?
Well, it's a couple of things just want to bring up for 2024. One is an interesting, huge winner, and that was utilities. The utilities are a huge winner because in producing new energy, most of it's geothermal. We're bringing in hydro. Of course, there's solar and wind that's now part. There's coal. But with the huge data centers coming in and drawing power for AI and chip production, that's huge. Also, with cryptocurrencies and the data mining that they do, that is a huge suck for energy. So the demand for energy has gone way up, and utilities have been a big winner. Mark, it's interesting. In the trailing 12 months, utilities are up, and these are usually a stagnant average annual return of single digits. They're up 37% in the last 12 months. Another big winner, of course, are the Magnificent Seven. This is the big companies like Google, Microsoft, Apple, Amazon. There's 7 companies that are now, those 7 as a capitalization of the S&P 500, they represent about 20% of the S&P 500, the Magnificent Seven, just those 7 stocks, because their market cap is so big. Market cap is share price times number of shares. And when you get over $1 trillion, that's new territory. Well, we're in $3 trillion territory with NVIDIA, with Microsoft, Amazon, Apple. To be at $3 trillion means that you have to have almost everyone on the planet buy your product to continue. And then after 1 year of that, how can you possibly grow at 20% a year? Now, to grow at 20% a year, 20% of $3 trillion is a $600 billion company. Now, market cap for Exxon, for example, is $60 billion. So you're creating 10 Exxon corporations in a year. That is highly unlikely to see follow through. There was a group, Mark, do you remember, were you young enough to remember the Nifty 50 stocks of the early 60s?
No, I was born in 1959 and it's now 2024 and I still do not understand the stock market. That's why I do this show with you, so I can gain knowledge.
Okay, well, the Nifty 50 stock were things like Eastman Kodak, Polaroid, General Electric. There were 50 stocks that if you owned, you were just guaranteed to make money. Well, those Nifty 50 stocks hit 1973, 74, and they crashed. They were down over 70%. A lot of people with, in our eyes, good justification, are making a case that this magnificent seven that we have now are our age Nifty 50 stocks that are being very much overbought. Now, the future for AI is very similar to the future of the dot-com stocks. Now, the dot-com stocks in 1998 and 1999 were up average annual returns of over 50% a year, and then they crash. So there's going to be a reckoning here in the AI group. So that's an expectation going forward. Another expectation is energy. How do you produce cheaper energy? So the United States is looking at a couple of things. Can we compete with China? Heck yes. If we can get energy prices down, throw a few robots in there to keep wages, payrolls down, you can compete with anyone. And the idea for energy is geothermal fracking. Geothermal fracking is where you tap the Earth's core. And in the past, it's been problematic because the drill bits have melted. Well, now they have lasers. So they go down with, instead of drill bits, they'll take the drill bits down until the drill bits get over 300 degrees Fahrenheit, and then they'll use lasers to break through the last part of the core and the crust. And they'll put water down there, and all the energy for coal and hydroelectric and geothermal and is to produce steam to turn a turbine. And that is the focus, the bullseye focus of any energy. And so the future of energy is going to be geothermal fracking. And that, I just read a report on that. So it's interesting to see the energy companies that take that up are going to be similar to the tech companies that have taken up AI. Now, another big winner this year in 2024 was technology because of the AI focus. AI, there's going to be winners and losers like in .com. Most of the .com bubble, when the bubble burst, the winners were very few. The losers were huge. The number of .com companies that went to zero and evaporated. So it'll be interesting to watch the technology group that have produced huge gains. Now, there's a time to own technology and a time not to own technology. If you haven't owned technology since October of 2022, for the last couple of years, you've left a lot of money on the table. If you did own technology from January 1 of 2022 to October 30 of 2022, you lost 30%. Boom, just like that. So that's why we at Decker Retirement Planning use strategy for risk called momentum. Momentum and relative strength investing buys whatever is going higher. So every stock, index, and ETF is given a relative strength score 0 to 100, and you buy the top relative strength stocks until something better comes along and you rotate into it. It is sector rotation, it is pure momentum, and it's relative strength investing. So that's why we at Decker Retirement, for the risk portion of our portfolio, don't have to guess. We have algorithms. We have 5 different momentum strategies that will move money into whatever is going higher. So for example, in 2000, 01, and 02, when the S&P was down 50%, NASDAQ was down 70%. There were many sectors of the market making money. Real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, healthcare. Those were making double-digit returns each year while most people lost half their money. Then the markets bottomed in March of 03, and what exploded to the upside for 4.5 years was small caps, emerging markets, technology, and semiconductors. And then rolling into 2008, that was a waterfall decline. Momentum stops you into cash if nothing is going higher, except for treasury bonds. Treasury bonds were up 22% in 08. Now, the latest hit in the market was in 2022. S&P was down 19%, NASDAQ down 33%, bonds down 20%, commodities across the board were down. But Russia had invaded Ukraine, And so the energy sector was on fire. This was the frackers, the drillers, the natural gas and crude oil companies and pipelines. Those were up 15 to 20%, while most people that year lost 30%. Momentum is, in our opinion, the way to maximize returns because you're cherry picking the best parts of the market and minimize the risk in the down markets because momentum will seek out and is designed to buy whatever is going up. So going forward, we don't have to guess what is going to do well because the momentum models the algorithms will steer our client money towards whatever sectors are going higher.
So at the end of the day, it's really about having a plan. Everybody's situation is unique, and that's how your team, Brian, and the team at Decker Retirement look at it. It's how can everybody's situation is unique and kind of some need more income, some need more safety. It's whatever they need is what you're trying to help them figure out, I suppose.
Correct. So when it comes, another thing that we look at for clients for their retirement plan, most people come to us and they're taking way too much risk. A 60-40 or 70-30 portfolio is what the bankers and brokers recommend because they get paid on your risk assets. And so that's in their best interest. It's not in your best interest. Our clients, we lower clients' risk 3 different ways. One is quantitatively. Our clients are taking about 25% risk, not 60 or 70% risk. The second is strategically. We just talked about how strategically we lower client risk by using momentum strategies that are designed to steer money into whatever is going up, even in down markets. And the third is categorically, we eliminate interest rate risk because we are not going to invest in bond funds. Bankers and brokers recommend bond funds for clients' safe money. We find that we will never do that here at Decker Retirement Planning. So when it comes to the risk reduction, that's very, very important. For next year, we don't know what the markets are going to be doing. So we want to have a portion of the portfolio laddered in principal guaranteed accounts. And in the next segment, we'll dive into what that looks like.
So certainly a lot going on, a lot that we deal with, holiday season and all of that, and a brand new year. What are the things we need to take care of? Brian's going to kind of look ahead and make some predictions for 2025 when we come back. It's 833-707-3030 if you'd like to have a conversation. I've got some questions, got some concerns. I'm not sure I'm invested the right way for my situation. Or, hey, I don't even have a plan. I would like to be able to retire in the next 3 to 5 years, but I don't know if I can. Find out. 833-707-3030. Again, it's complimentary to chat with the team at Decker Retirement Planning. No cost to you, no pressure, no judgment, no obligation. 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Just like the twinkling lights of Christmas, retirement can be a bright and beautiful time in your life. If you've been dreaming of a retirement filled with adventures, call Brian at 833-707-3030 to help ensure your dreams come true this holiday season.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, there's 12 different things you can download, including Brian's book on retirement, The Decker Approach. But there's also the 3 Principles book of retirement. There's a checklist challenge, a sample income plan. That's just 4 of the 12 things you can download on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. It's all there for your information. There's no cost to take any or all, or just to read through it. It's your choice. It's just there for your information. Again, if you have questions, you want to talk with Brian and the team about where you are on that road to retirement, 833-707-3030. Maybe you got some investment questions for the upcoming year. You're not really sure what areas look good and what don't. 833-707-3030. You know, a big factor, especially in 2022, was inflation. And it was, every week or every month we'd hear, hey, this is a new 40-year high. This is a new 40-year high, going back to the 80s. And so inflation is kind of coming down a little bit, but not maybe where the Fed wants it. I don't know. How do you see inflation?
Okay, and inflation is a tax on retirees. Here's why. Once you retire, a lot of your money is fixed income from Social Security, fixed income from pensions, fixed income from your portfolio. And those are fine today. But think back, I've been doing this 40 years, and think back, a lot of people nowadays, this is very, very unusual as long as mankind has been around. I don't know that there's ever been a time when people could be in retirement longer than they were working. So if you retire at 65, you could, after a 40-year career, potentially with longevity and biotechnology advancements, you could have quality of life for another 35, 40 years. So think back 35, 40 years, Mark. So what were homes priced at 40 years ago? What was gasoline 40 years ago? What was the cost of a gallon of milk, cheese, butter, eggs? Those prices have gone way up. And so if you're on a fixed income, you've got to price in your retirement plan. You've got to have a COLA, cost of living adjustment. So one of the things that we do in our plan, and one of the checklist items that Hope Radio listeners have in their plan, is a COLA, cost of living adjustment, where you give yourself a little more money every year for the rest of your life. Now, in our planning, by the way, the rules that got you here are not the rules that you use in retirement. For example, I hope this makes crystal clear sense. And by the way, this is probably one of the most important things I can say in this radio show today. In your 20s, 30s, 40s, and 50s, markets go down 30, 40, 50%. No big deal, because the income is coming from work, and your 401k, you're kicking money in every 2 weeks. And so you've got the time, the 3 to 5 years for the markets to recover. You kick money in to a down market. You actually benefit from a down market in a 401k working example where your income is coming from your employment. Now you're 65, you're retired, markets go down 30, 40, 50%. That portfolio that is producing income for your golden years of retirement is down 30 or 40, and you're not kicking money into it every 2 weeks. You're pulling money out of it every month. That is a killer combination. Let me say this another way. We're a math-based firm. When you draw income from a fluctuating account, you compromise gains when markets go up, and you accentuate losses when markets go down. And it works until it doesn't. Classic example, that 4% rule distribution plan that's used by bankers and brokers, in our opinion, is lethal in retirement, because if you get into a flat market cycle, now in the first segment of the radio show, we talked about this. In a flat market cycle, stocks go up and down, up and down, and up and down, and net nowhere for the next 10 to 15 years. That's where we think we are, because with 100% historicals, every time the market's traded above 30 times trailing earnings, we've gone into a flat market cycle. Every time that's happened, and it's happened again in October of 2021. We hit 32 times trailing earnings. So we expect next 10 to 15 years to be flat. So that means that if you're drawing income from a market where your portfolio makes no gains over the next 10 to 15 years, that is a killer. The 4% rule distribution strategy only works when the markets are in an uptrend. When the markets are in a downtrend, classic example, in 2000, 01, and 02, your markets are down 50% and you're drawing 4, 4, and 4. You're not down 50, you're down 62%. Then the markets double and you're back even in 2008. You earn the money back, but you didn't, because those 5 years you're drawing 4, 4, and 4. You're down 20% during that period. And then the markets drop another 50% in 08, and millions of gray-haired people went back into the workforce. We saw them in real estate, we saw them in banks, we saw them in fast food and Walmart, because they had to. The 4% distribution plan destroyed their retirement. We want to warn you that a pie chart is not a retirement plan, and the 4% rule has been discredited by its creator, William Bengen. And so we're getting off topic here a little bit, Mark, but I just wanted to point out that for predictions for 2025, it's very important to have a plan. In fact, 6 key points will do you well for 2025. Number 1 is to have a plan, and a pie chart is not a plan. Number 2 is tax minimization strategies. Very, very important that you work with someone that knows how to minimize your taxes. The Roth conversion strategy, in my opinion, is going to be one of the biggest tax saving strategies for people in retirement, for most everyone. And if it's properly used, it can reduce taxes in a huge way. But there's others. If you've got a spike in income, you need to use a donor advised fund to lower your taxes. If you've got highly appreciated assets, either in real estate or in stocks, and you don't want to pay the capital gains, use a charitable remainder trust. If you've got a big difference in age with spouses, you can cut your 401k in half and send it down to your younger spouse, so you've got more time for Roth conversion strategies. If you live in a state where you have exposure to state estate taxes or federal estate taxes and you don't want to pay that, or you want to pay it in a way where it's 10 cents on the dollar, we use the irrevocable life insurance trust. If you want to send money down to your grandkids and avoid the generation skipping tax of 48%, we use dynasty trusts. If you want to change your rental real estate into 100% tax-free income stream, we use cost segregation, and it continues. There's more. But make sure, for the second point, that you're working with someone knowing how to minimize your taxes, strategically lowering your risk by using momentum strategies that are designed to place your money into the sectors of the markets that are going up the fastest. Making sure that you eliminate interest rate risk by having zero bond fund exposure in your portfolio. Those are key ways that we lower your risk dramatically. That's number 3. Number 4 is optimizing every part of your portfolio, every part. So we look at the Wink database that lets us know what the highest earning principal guaranteed offerings are from banks and insurance companies on a monthly basis. We have client funds in laddered principal guaranteed accounts, so we want to know where we can get the highest earning money market account that's guaranteed. We know that. Where we can get the highest returns for 3 and 5 year CDs, we know that. We can get the highest returns for 7 and 10 year principal guaranteed accounts, which, by the way, those returns are twice the returns of CD rates. We know where to grab those. And finally, where to get the highest returns on principal guaranteed tax-free accounts. Because we do the homework, we are true fiduciaries to our clients, and we're a math-based firm. We do the homework so that we can optimize every part of the client portfolio. And then on the risk side, do we just plug in managers? No, we do the homework there again. Every quarter, we go to the databases. Morningstar database, largest database of money managers in the world. Wilshire database, largest database of money managers in the world. The Morningstar database, largest database of mutual funds in the world, and 3 other databases that we use to find the highest returning risk strategies so that every part of our client portfolio is optimized. That's number 4. Number 5 is maximizing our clients' after-tax monthly income. In the retirement plan, that is the most important number to us. That is maximizing what you draw in your golden years of retirement every month. And then the last one is fee minimization. Most people in the United States, 65 and older, that's retired, they pay 1% in management fees. Our clients don't. Because we don't charge any management fees for their principal guaranteed accounts, it's only the risk side. It works out, because risk is about 25% of the portfolio, it works out to where the fees as a percentage of total portfolio, our clients are about 0.3, a 70% reduction in fees. So those are the key parts: having a plan, tax minimization, risk reduction, portfolio optimization, income optimization, and fee minimization. Those 6 key things are going to do you very well in 2025. Make sure that you've got that. Now, when it comes, Mark, do we have time to hit about the Fed's expectation next year in 2025?
Absolutely. Go ahead, do that.
Okay. The Fed's expected to cut interest rates 2 more times. And if they do, the markets will trade flat because that's what's expected. If the Fed pivots and does not lower rates 2 more times in 2025, the markets are going to go down. Now, there's 2 general categories of stocks. There's growth versus value and different sectors of the market. Growth stocks are stocks that don't pay a dividend, and they are high price earnings ratio stocks, and they are on a tear. They're in the hot part of the economy, and they're growing very quickly. Value stocks are when you wait for things to sell off. It could be when Microsoft has taken a hit. Microsoft's a growth stock, but when you buy it cheap after it's been down 30, 40, 50%, you could call that a value purchase, buying things that are out of favor. The problem with value stocks is some of them never recover. Classic example in 2008. You've got to buy, radio listener, you've got to buy Washington Mutual. It was a $40 stock. Now it's 20. And now it's 10. Now it's 5, and boom, it went to 0. So some of these, like General Motors declared bankruptcy. So some of these value stocks are value for a reason. No one's wanting them anymore, and they may never come back. So value is tricky. There's a quick story. A friend of mine, when I was just starting, had an account with a guy in New York, and he bought what he thought was things that were out of favor. Well, his $1 million portfolio was cut in half pretty quickly because those things didn't recover. The guy said, I'll give you one more chance, but you can only buy stocks off the 52-week high list, pure momentum. Well, he made his money back very quickly, and he went on to be a very happy customer because he switched from value to growth and growth to momentum.
So if you'd like to learn more, how does all this pertain to you and your situation? Because at the bottom line, that's really what it amounts to. How can you be safe and secure about your retirement and really walk through the safer retirement process at Decker Retirement Planning? They can certainly do that for you. 833-707-3030 is the number. Again, this is totally complimentary, no cost to you. 833-707-3030. Best time to do it? Right now. Give them a call. Set up a time to come in early next year. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
This holiday season, while you're making your Christmas wish list, don't forget to include your retirement dreams. Give Brian Decker a call at 833-707-3030 to unwrap the perfect retirement plan for the future you're dreaming of.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Brian, of course, and the team at Decker Retirement here to help you figure out where you are on that road to retirement. Can I retire? Well, when can I retire? Do I have enough? Will my loved ones be okay if something happens to me? A lot going on, and it's really on our shoulders in retirement, more so than ever before. 833-707-3030 if you'd like to chat with Brian and the team. There's no cost for this. 833-707-3030. You've got some questions. You've got some concerns. Call the team. That's what they're here for. There's no cost. 833-707-3030. 30/30. I know you wanted to touch a little bit on geopolitics and supply chains. Supply chains was a big issue when you couldn't even have cars coming into the country because they didn't have the little computer chips. Or where are we with all this geopolitical challenge, supply chains challenges as well?
Well, Russia is very upset right now because we are giving missiles to Ukraine that are launched inside of Russia. So they don't like that. They're ramping up their drone attacks. By the way, militarily, the tank approach, army, boots on the ground, that's not how this war is being fought. It is video game controllers with drone attacks and bombs, missiles being launched from drones. That's how this war is being fought. So it's interesting to watch President Trump to see if he can do what he said he could do, and that's solve the Russian-Ukraine war, and we'll see what he does. But that's a geopolitical focus. The alignment of North Korea, China, and Russia is disturbing. China is saber-rattling like never before with Taiwan, saying that they have always been a part of Taiwan. So there's some geopolitical risks out there, and nobody on the planet really knows how this is going to play out. So that's why we in retirement planning have 75% of our portfolio has no risk. That gives tremendous peace of mind for clients so that they, no matter what happens, they don't have to worry about their income for the next 15 to 20 years. And the risk bucket portion grows for 15 to 20 years. It gives a big enough runway that with momentum strategies, it can adjust. Now, if China invades Taiwan, is your advisor going to make adjustments or tell you to ride it out? Well, I was trained on what they do. They're going to tell you to ride it out. Bankers and brokers, your advisor will tell you to suck it up and ride it out. The day after China invades Taiwan or any big geopolitical risk, our portfolios are going to automatically, by algorithms, be readjusted. So we'll have stop losses in place. Do you have stop losses? We will be moving to cash if a momentum piece of the market has lost its momentum. And depending on what the markets do as far as going in the right direction, the health of the market, we will decide if what our exposure to stocks are. By the way, I just want to say that most people have their decisions on picking their portfolio completely backwards. So Mark, you were raised that you pick stocks and put your portfolio that way, right? Stocks first, correct?
Right, sure, yes.
Okay, totally backwards. It should be markets first, sectors second, stocks last. So hear me out on this. So you look at the markets first. Is the market healthy? Should you be 100% in? Are the markets trading flat? Should you be 50% in? Are the markets in a downtrend? Should we be 25% exposure? So the market direction should be the first focus of your portfolio construction, the health of the market. Number two, sectors of the market. What sectors of the market are doing well? This should be reviewed quarterly. On a quarterly basis, you should be buying stocks in the sectors that are going higher, not buying stocks that you're holding for 15 to 20 years. There is significant risk, two big risks for the sake of time. I'll just bring up. One is there's no downside protection if you just buy it and ride it out. And second, if you're in a flat market cycle, you're going to have a zero return in the next 10 to 15 years if history repeats. And I guess there's a third one, and that is the risk that your stock will become very much out of favor. Portfolio stocks that held for 15 to 20 years, things like General Electric that hasn't gone anywhere in 20 years, Polaroid, Kodak, JCPenney's, Kmart, those are stocks that are now gone. The risk of technology replacing your stock or the company that you've invested in is dramatically high. So, for example, the cell phone has destroyed Kodak and Polaroid. The cell phone has destroyed the Baby Bells, AT&T, and the Baby Bells. Amazon is destroying retail as we know it. So there's a new alignment of things going on. Technology is changing the marketplace. And so portfolio updates should at least be quarterly. So that's how we recommend portfolios be put together. So Mark, for the rest of this last segment, let's talk about key takeaways of 2025. I hope that the biggest tax saving strategy is something that people use, and that's the Roth conversion. So I want to spend a second on this because this, for most people listening, is going to be their biggest tax saving strategy. A Roth account grows tax-free, distributes income back to you tax-free, and passes to beneficiaries tax-free. Why would you proactively pay taxes now? It's because there's 36 trillion reasons why tax rates probably have to go higher. If you think that tax rates are going higher, how smart are you to proactively pay taxes now so that that growth is tax-free? Let me give you an example. So I'm looking at numbers right here on my desktop. Take a 60-year-old with $1 million IRA growing at 6% a year. At age 73, they pay their required minimum distributions, and we killed him off at age 90. How much tax did he pay? Well, in his life, he paid $732,000. But wait, there's more. Because of the Secure Act, your beneficiaries of that IRA have 10 years to pay the rest. So that's another $718,496. Total of $1,395,228, almost $1.4 million in taxes. Now you should pull over if you're listening to the radio while you're driving, because this is nauseating. After 30 years of $1 million IRA growing at 6% a year, the net of tax transfer is a measly $1,223,385. 1.2 net is transferred to your kiddos. The IRA is easily the most tax inefficient vehicle on the planet. The IRS got $1,395,000. Your beneficiaries got $1,223,000. No accident there. The IRS and Congress loves the IRA. You should avoid it and play it wisely. So here's what we recommend you do. Use the Roth conversion. So in this second option, same 60-year-old, same $1 million IRA. Here, we proactively go after it. We pay taxes, $225,000, $225,000, $225,000, $50,000 a year, so that at age 73, the required minimum distribution age, there's no IRA left. It's all moved over to the Roth. We kill them off at age 90. How much tax does he owe? Does he owe $1,395,000? No, he owes $319,474. Almost 1.1 million less in taxes. Did the beneficiaries receive 1.2 million? No, they received 4.1 million. So the benefits of a Roth are huge, but there's a right and wrong way to do a Roth conversion. The wrong way is to say we should do Roth, let's do some. The right way is how we do it, and that is to look at your gross income for the year minus your standard deduction to arrive at your AGI, your adjusted gross income. Then you look at the tax tables, married filing jointly or single filer. Let's say you're in the 22 or 24% bracket, no big deal. Without raising your bracket, how much room do you have to convert IRA to Roth? And then you have the account pay the tax. So have the state and federal withholding done so that that money is moved net to your Roth, and then that account can grow tax-free. That is going to be, for most people, the biggest tax-saving strategy they have left in their life. So that's a key point. For 2025, we hope that you review and update your retirement plan. Hopefully you have a plan. Most people don't. A pie chart is not a plan. You look at a pie chart, and that's the reason why, Mark, I believe the number one fear in the United States for people over 60 years old is running out of money before you die, because a pie chart, no person, no matter how big their IQ, no one could look at a pie chart and see how much money they can draw and not run out of money. So people that come to us at Decker Retirement underdraw their account in a huge way. And so when they get our distribution plan, most everyone sees a big uptick in the amount of money that they can draw, because we show we're math-based. So we have our distribution plan is a spreadsheet that shows the income that you can draw. and they don't have that fear and anxiety of running out of money because they see how much they can draw and it's updated every year. So number one, key takeaway for 2025 is to make sure you have and update your retirement plan.
So number one is have a plan. And Brian and the team at Decker Retirement are certainly here to help you do that. Again, the number is 833-707-3030, complimentary, no obligation, no pressure, no judgment. It's just a great opportunity for you to get some clarity. Maybe you'll be a client of Decker Retirement, but worst case scenario, you just walk away and you've got way better clarity into your picture. It's just an opportunity for you to find out where you are and talk about the things that Brian talks about every week on this program. So again, that number is 833-707-3030. Brian, as always, enjoy it. Enjoy the rest of the weekend. Always enjoy our time together. Have a great weekend.
Thanks, Mark. You too.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.